Lessor accounting a problem with a guaranteed residual value. We just did a problem in the previous video with an unguaranteed residual value, so this is very similar, except this time it is guaranteed, and so it changes our accounting just a tiny bit. A DOM company, the lessor, enters into a lease with Davis Company to lease equipment to Davis beginning January 1st, 2019. Lease terms, provisions, and related events are as follows. The lease term is 5 years, it's non-cancelable, requires annual rental receipts of $100,000 to be made in advance at the beginning of each year. The equipment costs $313,000, has an estimated life of 6 years, and at the end of the lease term has a residual value of $20,000, which is guaranteed by Davis Company, the lessee. Davis agrees to pay all executory costs directly to a third party. The interest rate implicit to the lease is 14%. The initial direct costs are insignificant and assumed to be zero. It's probable that a DOM will collect these lease payments. Assuming the lease is a sales-type lease, calculate the selling price. And so because this is a guaranteed residual value, we need to do the present value of these 5 years of 100,000 payments, as well as the lump sum of the 20,000. And so we'll do both of those and then sum them together. So here we'll say equals negative PV, open parentheses, rate is 14%, comma, number of periods 5, comma, payment 100, comma, type at the beginning of the year, so type 1, close parentheses, and we get 391, 371, 23, which is the same as what we calculated in that previous recording. Now we're also going to record for the lump sum of the 20,000, so we'll say equals negative PV, open parentheses, 14%, comma, 5 periods, comma, there is no payment because it's a lump sum, so we just put another comma, future value is 20,000, comma, types at the beginning of the year, so we type a 1, close parentheses, and we get 10,387. And then if we add these together, we get the total selling price of $401,758.60. And so, and that's because it's guaranteed versus in the previous problem where it was unguaranteed, so we accounted for it separately. So because of that, the next part is to prepare the table summarizing the lease receipts and interest, and we're going to start out with that $401,758 as our initial lease receivable. We're going to have payments of $100,000, and so we'll do the same thing where we set our previous lease receivable minus payments plus the interest income, and then carry that down. And so it'll update as we calculate each interest income and lease payment received. So for December 31st, we'll have interest income of the previous balance times 14%. And then actually, I think we can just copy these down. And so you'll notice this time another difference being that our ending balance is the 20,000, which is the same as that guaranteed residual value of 20,000. And so then the third part is to prepare the journal entries for 2019 and 2020. Oh, excuse me. On January 1st, 2019, we're going to start out with our lease receivable and our sales revenue. And it's going to be for this $401,758 that we had calculated. Then on the first, we'll do our cost of goods sold and our equipment leased to others. Can't seem to type today. For the $313,000 that was given up here, 313. Also on the 1st, we receive our first cash payment. So we have a debit to cash and a credit to lease receivable for $100,000. Then December 31st, we're going to have lease receivable and interest income. Which we can pull down from our table, the $42,246. And that concludes 2019. So then in 2020, on January 1, we're going to have the same cash receipt and lease receivable for $100,000. And I'm just going to actually copy down the lease receivable and the interest income as well. And we'll just do a new cell reference because the journals stay the same. We just need to reference the $34,000 this time. And that's it.